Why do most companies' margins go down as their sales go up? Invariably, companies become less efficient as they grow. Where will this always show up? In the company's financials. This is how to perform a simple trend analysis. Export your last 3 year-end P&Ls to Excel and copy and paste them side by side just like this. Then, off to the right, create another 3 columns for each expense as a percent of revenues, which you get by dividing each expense line by that year's total revenues. Then, we look at all costs in 2 categories: production costs, or cost of goods sold, and fixed costs. Evaluating production costs will reveal the company's production efficiency, and the fixed costs will show us the owner's ability to control the company's overhead. Since production costs, such as production labor, rise and fall as sales rise and fall, the expense amount is less useful than its percentage of sales. When we see the percentage of labor increasing year over year as it is here, we know that we have a labor efficiency problem. This means that the labor force is growing less efficient. Less work is being performed per labor hour. People are being hired faster than sales are increasing. Or people are getting raises or more employee benefits without offsetting benefits, etc. The company's net margin will naturally decrease as the production cost percentages increase, but it will shrink even faster if the company's fixed costs are increasing at the same time, which creates the perfect storm. We now examine the fixed costs to see where we are losing efficiency. Fixed costs do not typically rise or fall as monthly sales rise and fall, so here the actual dollar value is more relevant than its percentage of sales. However, as sales increase, hopefully each fixed cost line should become a smaller percentage of revenue. Ideally, rent expense should not keep pace with increasing sales. As sales increase, rent should decrease as a percent, adding new profit potential. Here again, we see that fixed labor is trending up, but so also are his leases. This means that the owner is adding new assets faster than the company is growing, another red flag identifying inefficiencies. Without this knowledge, this company could grow itself right out of business. Companies don't succeed based on just a few big decisions, but rather with many little ones focused on what matters most. Through this 2-minute exercise, you just saw what matters most to this company.